and she was pretty upset. I mean, very visibly, because I was moving this money out of this bank and the money was leaving this bank. So now they had less money that they could use to lend out to other people. And she called up a different bank manager and they both tried to convince me to. What's up, everybody? I'm Jaspreet Singh, and the way the system is designed, if you blindly follow what everybody else does financially, you are going to have a very difficult time becoming wealthy. That's why if you want to become wealthy, you have to break away from the majority, you have to start thinking different, and you have to be financially educated, which unfortunately is not something that we're ever taught. So what I want to do in this video is go over some of the things that are keeping so many people poor by going over some of the biggest money myths. So let's jump right into it. Most people assume that if you want to become rich, what you have to do is either you're going to have to become a doctor or a high-paid professional, or you have to have this money just fall into your lap somehow. The reality, especially in our economy now, is we have so many high-paid professionals, doctors, engineers, attorneys, executives who make a big salary but are struggling financially. As soon as you make money, you have to pay half of this in taxes, and now you have to live off of what's left. And people expect that if you're a doctor or if you're a high-paid professional, that you have to look like a doctor or a high-paid professional. You gotta have the nice house, you gotta have the nice car, you gotta have those nice vacations, and that's why so many people who are high-paid professionals never have the opportunity to build wealth. The real reason why people become wealthy or don't become wealthy is not what degree you have, it's not who your parents are, it's not what job you're working, it's what you do with the money that you earn. I mean, we've made multiple videos on our channel where I talked about people who earn minimum wage. Maybe they were janitors or they worked at a parking lot and they retired with millions of dollars, while you have high-paid professionals that don't have a penny to their name. The one thing that differentiates somebody who becomes wealthy and can live the life of their dreams and somebody who cannot is your mindset. Because if you have the right mindset, if you have the right financial education, then you will have the ability to go out and take risks. You will have the ability to know what kind of risk to take, and you will have the ability to go out and do something with your money. That way you can go out and actually become wealthy. And that's why in this video, I'm going to be going over 5 lessons to understand what it takes to become wealthy. That way you can understand the difference between the rich and the poor mindset. The first thing that all wealthy people understand is the difference between an asset and a liability. Now, this might seem intuitive, but the reality is many times we don't understand what is an asset and a liability, because the majority of people are buying liabilities thinking that they are assets. The way that I look at assets and liabilities is that an asset is something that puts money into your pocket, and a liability is something that takes money away from your pocket. The 3 biggest liabilities that the majority of people have that most people don't even realize that are liabilities are: 1, your house; 2, your car; and 3, your cash. So let's talk about these 3 things. Let's start by talking about your house. Everybody says that your home, the home that you live in, is your biggest investment. I mean, everybody says this. I'm a real estate agent, I'm a real estate investor, and I'm an attorney. So I've heard this from so many different angles. Every real estate agent is going to tell you that your home is an investment. Every banker is going to tell you that your home is an investment. The government is going to tell you that your home is an investment. So what do people do? Well, when people think that their home is an investment, they're going to go out and they're going to say, okay, I can comfortably afford a $300,000 home. But if my home is an investment, how about I go out and buy something a little bit bigger, a little bit nicer? So now you go out and you stretch yourself a little bit thinner, and now you go out and you buy a $400,000 home. And then as soon as you move in, you're gonna wanna renovate the kitchen, and then you're gonna wanna renovate your master bedroom, and then you're going to want to repaint the home, and then your furnace might break, you're going to have to pay for that. And then a few years later, your roof is going to start leaking, then you're going to have to pay for a brand new roof. And so most people's homes end up becoming a money pit, because now every single month you're paying for upgrades, you're paying for repairs, you're paying for maintenance, and this is something you have to do with your home. What I tell people is, if you're serious about becoming wealthy, before you go out and buy a home to live in, go out and buy a rental property, because when you buy a rental property, you're going to buy it for one sole purpose: to make money. The home that you're living in, you're not buying it to make money, you're buying it to make memories. And so now when you buy this property to make money, it's going to be paying you with cash flow every single month, and you can use this cash flow to now pay for the home that you live in. The first property that I ever bought was a small 1,000 square foot condo, and I didn't buy it for myself to live in. I bought it to rent out to somebody else, and after all expenses, after I figured out how to do the whole real estate investing thing, this condo was paying me somewhere between $250 and $350 a month in profit each and every month, and this is cash flow that I was getting without having to do anything. So I want to own rental properties if I want an asset rather than just a home, which is a liability. Now, don't get me wrong. There's nothing wrong with owning a home, and it's better to own a home than to own nothing, but there's so much more that you can do than just thinking that you need to take all of your cash and use it to buy a home, because your home is what is going to make you wealthy. Your home is going to give you generational wealth because you own your property. This is one of the biggest lies sold to the masses, because it's an easy way to sell you to go to your bank to pull out money to go buy this property that you're going to live in, and now this home becomes a money pit for so many people. The reason why I look at your home that you live in as a liability rather than an asset is because now anytime you put $1 into renovating your property, you have to do that with after tax dollars. So you make money, you pay taxes, and then you have a little bit of money left. Now you take this little bit of money left and you're going to put that into a new kitchen. Versus with a rental property, I make money, I spend money on renovating kitchens, and then if there's any money left, that's what I pay taxes on. So you're taxed very differently. Second, the cost for you to live in your home will always keep going up, even if you don't have a mortgage, because every single year you're gonna have to pay more money to maintain your home, and your property taxes are always going to keep going up. And if you don't factor that cost into your income, well, then you could run into a problem where one day you have a fixed income, but now your property taxes go up, and now you can't afford your property, even if you don't have a mortgage, because your property taxes are so much more than what they were when you first bought your home. And third, one of the most expensive costs are missed opportunities. Because now if you take all the extra cash that you have and you use it as a down payment for your house, and you take all the extra money that you have after the end of every month and you use that to renovate your kitchen, and you use that to renovate your bathroom, and you use that to renovate your bedroom, well, now you don't have the cash to go out and invest in opportunities that might come your way, and that can be one of the most expensive costs there are, because now you're missing out on all the other opportunities. That's why I want you to invest first and buy the liability second. The second liability that keeps so many people broke is your car. Now, most people understand that your car isn't gonna make you money, but what most people don't understand is how much your car is actually costing you. Because the way most people look at their car is, okay, I'm gonna go out and buy myself this nice $35,000 car, and it's something that I need because I need a car to get to and from work, and it might cost me $500 a month, and then you add in your insurance and your gas and your maintenance, maybe it's gonna cost you $600 a month, and this is something that you hold on to for 5 years because you're financing your car over 60 months. But what ends up happening for so many people is 5 years go by, you no longer have a monthly payment, and then instead of keeping your car, you say, this is kind of weird, I don't have any monthly payments. So then you go out, you trade in your car, and you go out and buy a new car, and you start the payments game all over again. And so now for the rest of your life, you have this car payment because this is just what's normal. Everybody has a car payment, and every few years you flip into a new car and the payments start all over again. The real cost of your car is not just that $500 that you're paying to your car company and your bank every single month. It's the missed opportunity that you could be doing with that $500. Because now, if you took that $500 a month and instead of giving it to your car company and you paid yourself, so you use this $500 and you use this money to invest. I don't care where you invested, whether it's stocks or real estate, whatever, and you can just get an average 8% return, and you do this for 50 years. Now after 50 years, your $500 monthly investment that you were given to your car company is going to be worth more than $3.5 million in your bank account. That's $3.5 million of missed opportunity that so many Americans are just throwing away because they're letting their car drive them instead of them being able to drive a car that they can actually afford. So what I want you to do is, instead of you going out and financing a car that you can't afford, go out and buy a car with cash and take that extra cash that you're no longer giving to your car company and you're no longer giving to your bank, and take that cash and pay yourself by investing this money into yourself. Now you don't have to wait 50 years to start enjoying your money. It's just you using this money to pay for yourself, that way you're not buying a whole bunch of liabilities that you cannot afford. I want you to build your wealth. Build these assets first. Real estate, stocks, build the things that are gonna pay you before you start paying everybody else. And the third biggest liability that so many people don't understand that is a liability is your cash. I grew up in a traditional Indian household. My parents are immigrants from a state in India called Punjab, and the traditional Indian mentality is a saving mentality. It's a save first mentality. And so I grew up being told that if I want to become wealthy, I need to get a high salary, I need to become a doctor, and then I need to save as much money as possible. But the reality, especially in our environment that we're facing right now, is that saving is losing. We are in an environment where money is printed like crazy. So the value of our dollars keeps getting diluted, and the value and buying power of our dollars keeps going down. So now, if you want to go out and buy something, it's going to cost you way more today than it did 10 years ago. It's going to cost you more today than it did 20 years ago. And this trend is not slowing down. So these dollars that you keep in your bank account, which are not growing, because if you go to your banker and you ask them what interest rate they're paying you on your savings, it's going to be next to nothing. So your cash is sitting there flat. It's sitting there dead while the price of everything else keeps going up. So the value of your dollars is dropping very quickly. So what you want to do is you want to take this cash that you have and you want to put it here. You want to spend as much cash as possible. And when the majority of people hear that, what they think is, okay, well, let me go to Louis Vuitton, let me go spend my cash. But let's talk about that for a second, because one of the richest people in the world happens to be the owner of Louis Vuitton. And the reason why he became wealthy and the reason why he became one of the richest people in the world isn't because he was going out and spending all of his cash buying name brand things. It was because a whole bunch of people want to look rich, and the way they're able to do that is by giving Louis Vuitton all their money. See, Louis Vuitton for him is an asset because people buy Louis Vuitton from him. But for the majority of people, Louis Vuitton is a liability. To take one liability and they convert it for another losing liability. See, what wealthy people understand is that your cash, your savings are never going to make you wealthy. Instead, you need to understand what to do with your cash. First, you need to have some cash for an emergency. You want to have somewhere between 3 to 12 months worth of expenses sitting there. That way, if something bad happens, if you lose your job or something happens to your car, you have some cash to fall back on. This is your emergency money. Second, you want to save cash for a big purchase. You want to buy a home, you want to buy a car. This is why you should have some cash to buy these things. And third, the last reason why you should be saving cash is to buy an investment. If it doesn't fall into one of these three things, you should not be saving cash. After you hit that emergency fund, after you have cash for whatever big purchases, the rest of your cash needs to be going towards your investments. Now that doesn't mean that your money has to be invested tomorrow. That just means this money is intended to be invested. So when an investment deal comes your way, you have the cash to invest. And so now what you're doing is you're taking this liability and you're turning it into an asset. What most people do is they take this liability, cash, and they turn it into a bigger liability, Louis Vuitton. Now, again, there's nothing wrong with having liabilities. There's nothing wrong with having a nice home. Nothing wrong with having a nice car. There's nothing wrong with having Louis Vuitton as long as you can afford it. That's what I want you to understand. Wealthy people build this before they build this. They want to let their assets pay for their liabilities. The majority of the world build this so they look right, they're rich and they have nothing here. I want you to understand how money works. That means build this and let these pay for these. The second lesson that every wealthy person understands are the different phases of building wealth. When somebody has the realization that, okay, I need to be better with my money, I want to become wealthy, I want to have this financial freedom, the first thing that everybody goes through is you go through the saving phase because you realize that, hey, I need to have some extra cash. And one of the most accessible ways to have some extra cash is to stop giving all your cash away. So now what you do is you enter the saving phase. You want to know, how do you save the most money possible? You become a penny pincher. You stop going out to Starbucks. You stop buying nice things. You stop going on vacations. And this is where the majority of people get stuck. They assume that you have to keep doing this forever if you want to become wealthy. They become penny pinchers and couponers for the rest of their life, and they never want to spend a penny because they want to become wealthy. But the reality is you will never become wealthy just by saving your money, because there's a limit to how much money that you can save. If you make $50,000 a year and you are saving 50% of your income, well, now you're saving and putting inside $20,000 and you're spending $20,000. If you want to be even more aggressive, maybe you can save and put aside $25,000 and you're living off of $15,000. Maybe you can live off of just $10,000 and you can save $30,000. But there's a limit to how much you can save. But there's no limit to how much you can grow. And this is where now you got to go to the next phase. You have to know how to live below your means. If you do not know how to live below your means, if you do not know how to save your money the right way, if you do not know how to spend your money here, you will never be able to become wealthy. Because if you're able to grow your income to $1 million a year and you don't know how to manage this money, well, you're not going to stay wealthy for very long. So you got to understand how to live below your means. This is the first stage of becoming wealthy. The second thing, and very few people come to here, is you need to know how to grow your money. How do you now grow the pie? Here you're thinking, okay, I'm making $50,000 a year. How much can I put aside to start building my wealth? Here you're trying to figure out, okay, how do I go from 50,000 to $500,000? Or how do I go from 50,000 to 5 million? You're trying to grow now. So you're looking for ways to invest your money. You're looking for ways for you to increase your income. You're looking for ways to grow the money that you have. That way you have more money. That way you have the cash to invest into things that are going to pay you with passive cash flow. That way you can have this sort of financial freedom. Once you get here, you're going to still be making a lot of financial sacrifices, because what you're going to realize is, hey, this making money thing is kind of fun. You're seeing how you can grow your money, and you're gonna wanna grow your money as fast as possible. So you're gonna be taking every extra penny that you have, and you're gonna wanna put it here. But eventually, you're gonna get to the point where you're gonna say, all right, I need to know how to spend my money. How do I get my time back? How do I spend my money in a way that's going to benefit me in the most possible ways? How do I get to live my life the way I want while continuing to generate this passive income? This is where now you have to know how to spend. Very few people actually make it to this stage. Most people get stuck here. They just start becoming a couponer, they start saving pennies, but then they never realize that a penny saved is just a penny, and then they never make it here. Then some people start growing their money and they realize, hey, this is cool. I'm starting to grow my wealth. But this is where you hear of people who die with millions of dollars but never had the opportunity to actually enjoy their money because they didn't know how to spend their money. So you want to understand this and then move here and then move here. Once you start to develop that wealth, you need to know how to spend your money in a way that's going to benefit you in the most ways possible. How do you buy your time back? How do you buy the most value in your life? And how do you start enjoying your life and enjoying the money and the wealth that you work so hard to build? Now you can start buying the liabilities. Now you can start buying the nice cars. Now you can start buying the nice clothes without worrying about it. But you need to know how to spend your money the right way, because you don't want to just blow all your money, because now you're going to end up broke again. And you don't want to spend no money, because why did you work so hard to earn this money? So you need to know how to spend, you need to know how to give, and you need to know how to manage your wealth once you get to here. The third lesson that wealthy people understand that the majority of people don't is that wealthy people have a growth mindset, while the majority of people have a limited scarcity mindset. This goes back to what I was talking about earlier. See, what most people do is they make this much money and this is their expenses, and they say, okay, I want to become wealthy, so I need some extra cash. So how can I squeeze my expenses down to here? So now I have only this many expenses and I can take this extra cash and invest it. But what I want you to understand is, yeah, you got to know how to do that. But the second thing you got to do is you need to know, how do I take this income and grow it to here? Now, you can have even more expenses, but you have so much more money that you can put towards your investments, because now we're working on growing the pie instead of just trying to figure out how to squeeze another penny out of the pie. One of the things that I like to say is that a penny saved is just a penny. So you got to understand that pinching pennies has its purpose. You got to know how to live below your means, but you got to think bigger than that. You need to have this growth mindset. You need to know how to grow the pie. And the reason why this is hard for so many people is because it requires you to think different, and it requires you to spend money. Like, one of the things that we do in our business here at Minority Mindset is we're always trying to think about how can we increase our expenses. The reason being is our goal is to increase our expenses so we can increase our income. When I talk to my friends who are newer real estate investors about real estate, one of the biggest issues that all of them have is, why should I be paying a property management company $100 a month to manage this property when there's really not that much work? The tenant pays rent every single month, and yeah, you got to pay a property tax bill, and you got to make sure that the tenant pays. But what's the big deal? Why can't I just keep this money in my pocket? And then when we're hanging out on Saturday evening, they get a call from their tenant saying, hey, something's wrong with the toilet, or hey, the shower is leaking. And now my friend has to go out and they have to call their contractor. Their contractor has to go to the property. Their contractor is going to say, hey, it's going to cost me $350 to pay for this. Now you're going to say, oh, can you do it for $300? Now you got to deal with the contractor. The contractor is going to have to work with you as the owner to make sure that the job gets done. The tenant's going to be calling you, yelling at you because they're not happy about the time that the contractor went out there. Your tenant forgot to pay the water bill, so now you are the one that's getting the letter from the city, and you have to pay the city this back water bill if the tenant doesn't pay. And if the tenant doesn't pay his rent, now you're the one that has to deal with the eviction process. Or you can hire a property management company, pay them a little bit of money every single month, because they'll just take a percentage of whatever rental income that you're getting, and you can do none of that. And you can let the property management company deal with the headache, make sure you're getting paid, because they're experts at that. If you are a new real estate investor, you don't know the ins and outs of dealing with tenants. You don't know the ins and outs of dealing with contractors. You don't know the ins and outs of dealing with cities. And if this is what they do full time every single day, all day, you might as well pay them a little bit. That way you get their expertise, and now you got your time back, and now you can use your time to invest in more properties and to grow your portfolio. Yeah, you got to increase your expenses every time you buy more properties because now you have to pay them to manage more properties, but your goal is this. You're trying to grow the pie rather than just trying to squeeze a few pennies out of the pie. I don't manage any of my rental properties. I have a property management company that does that. They know what I want, they work with my goals, and they make that happen. And my goal is to do this. I'm trying to grow the pie instead of just trying to squeeze a few more pennies outside of it. The next thing that happens is people say, oh, well, that's easy for you to invest in real estate because you have the money to do that and you have the experience. I can't do that because I can't find a real estate property for less than $2 million. And so what are you doing? You're creating limitations for yourself. You're telling yourself that you can't do it. As soon as you tell yourself that you can't do something, I guarantee you will not be able to do it because your mind has already turned off. It stopped looking for ways to do it. So what you got to do now is you got to start looking for opportunities, because I guarantee if you spent as much time looking for opportunities as you were being a cynic, as you were hating, as you were complaining, chances are you're gonna find a whole lot more opportunities come your way. So what you can do now is start looking for opportunities maybe outside of your city. Look in the outskirts, look in a different state. There's a lot of real estate opportunities outside of just one locality. So you gotta start looking in different places and you'll be able to start finding other real estate opportunities. The next thing people say is, I don't have the money to invest in real estate. How in the world can I start investing in real estate? Again, now it goes back to, can you find this growth mindset? Can you find opportunities? The majority of people are going to sit there and complain, but you want to be the person that's finding the opportunities. When I realized that I wanted to be a real estate investor, I jumped in with both feet. I started going to real estate seminars. I joined the local real estate investor meetup in my area, and so I would start to go to these monthly or bi-monthly events. I became a real estate salesperson, and because I became a real estate salesperson, I got to meet a whole bunch of other real estate agents, and my real estate broker happened to be somebody that taught real estate investing. And so I got to know her, and so I started to get it out there, and I started to meet as many people as possible. And when I realized that I didn't have enough cash to want to buy properties because buying real estate is expensive, that's when I started looking for new ways to start generating cash. And at one of the real estate seminars that I attended, there was a couple people talking about this way that you can buy real estate with no money down, but you're not actually buying real estate. You would enter into the contract to buy a property, and then you would flip the contract to somebody else, so you have no risk, and you could walk away with a decent chunk of change in your pocket. So if there was a home on sale for $100,000, you would enter into contract to buy it for $90,000, and then you would turn around and you would sell this contract to buy the home to somebody else for $97,500. So you enter into a contract to buy it for $90,000, you sell it for $97,500, and now you sell the home, you keep the $7,500 difference, somebody buys a home for below market value, and the person that has a $100,000 home is happy because now they can finally sell the property. They've probably had the home listed for a long time and they haven't been able to sell and they need to sell, and now they finally have somebody to sell, so everybody walks away happy and you get to walk away with a big check. When I started learning about the system, I got really intrigued. The problem was, if I wanted to learn how to do this in more depth, I had to pay the teachers $3,500. And that was a lot of money for me back then, but I wanted to invest in myself. Remember, I wanted to increase my expenses, that way I could increase my income. So I invested in myself, I learned how to do it, and then I started doing this exact same thing. It's called wholesaling real estate. It took me months to get my first sale, but I made my money back many times over, and this was now cash that I could start using to buy more real estate. If you're not willing to invest in yourself, maybe it's to hire somebody who can help you grow, or maybe it's to go to a seminar, or maybe it's to buy a class, or maybe it's to buy a book. If you're not willing to invest in yourself, nobody else is going to be willing to invest in you, and then you're going to be limited right here. You have to develop this growth mindset, and you have to be willing to learn from people who are already doing it. And a lot of times it's going to come at a price. So you have to be willing to invest in yourself, invest in your own education. That way you can grow the pie into something bigger. See, the majority of people hate the idea of somebody else making a profit off of them, so they make it their mission to make sure that nobody profits off of them. I love it when people profit off of me, because if someone's profiting off of me, that means I'm getting some value. I like buying things that give me value. And I have no problem if somebody's profiting off of me as long as I'm getting some value in return. And so what I'm looking for is not what the cost is, I'm looking for the value that I'm getting in return. And this is the difference between somebody who becomes wealthy and somebody who stays broke, because if you're always worried about somebody making $1 off of you, you will never have the opportunity to go out and make $2 because people are so worried about losing $1 that they miss out on the opportunity of making $2. So what you need to do is you need to start developing this growth mindset, and instead of just looking at the price that you have to pay, start looking at the value that you're getting, because what you want to start doing is you want to think about how you can grow your pie instead of just trying to squeeze a few more pennies out of your pie. The fourth lesson that wealthy people understand that the majority of people don't is the correlation between money and happiness. See, the majority of people put up the smoke screen because they don't have money, they don't understand money, so they say things like money doesn't matter, money can't buy happiness, you shouldn't worry about money. These are the things that I grew up hearing. But at the same time, I would see my parents go to work every single day. They would go early in the morning, they would come back late at night. I barely saw my parents when I was growing up because they were always working to make money. And this is where things didn't make sense to me. If money doesn't matter, if I shouldn't talk about money, if I'm not allowed to talk about money, why in the world are you going to work every single day just to get a paycheck? See, the first thing that you have to understand is that money itself is just a tool. It's the tool that you use to pay your bills. It's the tool that you use to fund your vacation. It's a tool that you use to live the life that you want. Money itself is not going to make you happy, but money is something that is important for you to be able to live your life, because most people are scared to say that money is important. But the reality is, if money wasn't important, you wouldn't have so many people miserable at jobs they hate, going home telling their kids that, hey, you shouldn't worry about money, just go to school, go get a degree, and go be miserable earning a paycheck doing something that you hate because money doesn't matter. But the reality is, money matters. For so many people, if you didn't have to stress about your bills, if you didn't have to worry about how you were going to fund your kids' education, if you didn't have to worry about how you're going to pay for your next vacation, if you didn't have to worry about how you're going to buy that gift that you want for your spouse, your life financially would be a whole lot easier. Now, the thing that you have to understand about money is that money is just one aspect of life. We talk about money quite a bit on our YouTube channel because, well, we teach financial education. So we focus on the money aspect, but there's a whole lot more to life than money. And you have to remember that. And you need to know how money plays a part in your life, because a lot of people get this confused. They assume that, hey, I'm miserable, I have no friends, I hate my life, but if I have $1 million, I'll be happy and I'll be able to live my dream life. And then if you ever achieve that million, you're gonna realize that now you're more miserable than you were before, because now you thought that you did what you needed to become happy, and now you don't have that happiness, and now you're gonna be even more miserable. So what you need to do is you need to know how money plays a part in your life, that way you can enjoy the wealth that you have, and that way you can use your money to amplify your happiness. There's 4 aspects to life. I call this my quadruped theory, that you have to know how each aspect of your life fits on top of one another. At the bottom of this quadruped triangle is what I call physical fitness. You have to be physically healthy. If you are on your deathbed, you don't care if you have $10 million in the bank. The only thing you want to do is be healthy. The only thing you want to do is be able to breathe. The only thing you want to do is to be able to go outside and walk again. So if you are not physically healthy, that's the first thing that you have to take care of. Because if you don't have the ability to breathe, if you don't have the ability to live your life, well, that's gonna hold you back from doing anything. So you need to make sure that you're physically healthy. Then you need to make sure that you are mentally happy. So this goes to, who do you have around you? What are you doing? Are you happy right now? Because if you're depressed when you're worth $10,000, suddenly having $1 million is not gonna make you not depressed. You gotta take care of your mental health, and you gotta invest in that. If it's gonna take you $20,000 to go into rehab to get your mental life in order, go and do it. Because that's the cost that you will never be able to fix just by having more money. You need to take care of your mental health, and if this is not something that you're taking care of right now, it's not suddenly gonna be fixed when you have more money. So you gotta understand, you gotta be physically fit, you gotta be mentally fit, and then you need to be spiritually fit. Spiritual fitness doesn't mean religion. This means, what is your purpose? What is your reason for waking up in the morning every single day and wanting to conquer the day? If you don't love what you do, if you don't have a reason to get up every single morning, it doesn't matter if you got $10 million in the bank. You have no reason to get out of bed. You need to have a purpose. What is your reason for getting up every single morning? This is the reason why you're living life. You need to know this. And then once you have these 3 things, this is where financial fitness comes into play. Now, once you have this, more money can just amplify your happiness. You need to understand that money is just a tool. Money is just here But if you don't have money, it can ruin everything else. If you don't have money, well now it can be a lot harder for you to be spiritually fit because you can't do what you love because you gotta keep going to work every single day, making money doing something that you hate. If you don't have money, it can ruin your mental fitness because now you're stressed about your bills. You're stressed that you cannot give your wife or your husband what they want. You're stressed that you can't pay for your kids' college. This can destroy your physical health because now you're eating at McDonald's every single day. If you do not have money, it can destroy all of this, but you can't have happiness without all of this. So you need to understand how money plays a part in your life. Money is just a tool. It doesn't make you a good person. It doesn't make you a bad person. But you need to understand how money works and how money plays a part in your life. That way you can use money to amplify your happiness. And the fifth lesson that wealthy people understand that the majority of people don't is how the wealth ladder works. See, the majority of people are focused on the corporate ladder. They want you to climb the corporate ladder, which looks like this. At the bottom, you have your laborers. These are the people that are your janitors, your cashiers, your blue-collar workers. These are the people that are earning close to minimum wage, your laborers. Above that, you have what I call your workers. These are the people that go to college and you have a nice college job. You might be an analyst. You might be one of those people that's making, your decent living. You have a good job. And now if you have this good job and you keep working up the ranks, you will make it up to the executive level. Now, we're talking about the big bucks. You're the one that's helping make the decisions for the company. You're the one that's thinking about how the company works. Your job is now to think instead of just to work and push papers. This is what most people think about when we talk about the corporate ladder. You want to go from just your laborer to a worker to the executive, to the thinker. Because what wealthy people are trying to do is they're not trying to climb this corporate ladder, they're trying to climb the wealth ladder. And so they understand what's going on here, but what they really want to do is they want to be this person right here. They want to be the owner. They want to own the corporate ladder. Just take a look at Coca-Cola. Who is the highest paid person by Coca-Cola? And most people are going to think it's the CEO, but that's not true. The person who's making more money than the CEO is the owner of Coca-Cola. In 2021, the CEO of Coca-Cola will make something around $17 million. A lot of money. His name is James Quincy, and he's gonna make a lot of money because he runs Coca-Cola. He made it all the way up here to the executive level. But the person who's making more money from Coca-Cola than the CEO is the owner, someone like Warren Buffett. He owns a lot of Coca-Cola, and in 2021, he will make something like $650 million in dividends from the Coca-Cola stock, and he didn't have to work a day at Coca-Cola. He didn't have to go out and manufacture any Coca-Cola. He didn't have to go out and tell the workers what to do. All he did is over the years, he owned and accumulated as many shares of Coca-Cola as possible, so he became one of the biggest owners of Coca-Cola, and because of that, when Coca-Cola pays out their dividends, he gets the big checks, and he's not the one that's going to work every single day to run the company. So what wealthy people are trying to do is they want to become the owners, not just of companies, but of assets. We talked about this in the first part of this video, assets versus liabilities. Wealthy people want to be the owners. They want to own the means of production. They want to own the assets. That might be owning businesses. That's what Warren Buffett does. But you can also own real estate. Real estate can pay you with cash flow every single month because if you have an apartment complex, now these tenants are going to be paying you rent to live in your property. So there's a lot of different ways that you can be an owner. You can go out and you can own other businesses that you don't have to work in physically. So you want to be the owner, not just the person climbing up the wealth ladder. Now, there's nothing wrong with working a job. Not everybody can start their own business. But what you need to do now is you got to understand, okay, if you're working to earn more money, why are you trying to earn more money? Most people want to climb this corporate ladder. That way they can go out and buy a nicer car, they can buy a bigger home, they can go on more vacations. I don't want you to think like most people. You need to think like the minority of people. When you're climbing the wealth ladder to make more money, the reason why you need to be making more money is so you can take this more money to buy more assets. When you buy more assets, these assets are going to be paying you more money every single month, and then you could take this more money that you're making from your assets to go out and buy more liabilities. So you need to know, why is it that you're earning more money? This is where so many people get it confused. So you got to understand the game. You don't want to be the person that's just climbing the corporate ladder to earn more money, to buy nice things. You want to be the person that's working hard to earn more money, to own more assets. We're going to jump back into the video in just a second. But before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who've been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with the free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. I grew up being told that if you wanted to become successful or rich financially, all you had to do was become a doctor and then save a whole lot of money. My parents are immigrants from India, and so I grew up with saving in my blood. Savings? Are you there? Here's the thing, if you work really hard and you earn $100 and you save this money in the bank, what are you actually saving? I mean, it took you effort and labor and work to earn this $100, and when you save this money in the bank, what do you end up actually saving? I'll get to that in just a minute, but before I get into answering that question, let me show you this. Let's assume that you have a nice job where you are earning $50,000 a year, and in order to earn this $50,000, you're working 40 hours a week for 52 weeks a year. So you're putting in 2,080 hours in order to earn this $50,000 of money. Now, what you have to ask yourself is, what is this $50,000 that you're earning? I mean, it's $50,000 worth of money, but how much effort is really required to earn or create that $50,000 that you had to work to earn? Because the government can create or print that $50,000 before I can even finish the sentence with just the push of a button. So Robert Kiyosaki, the author of Rich Dad Poor Dad, really made popular this idea that our money, these dollars that we work so hard to earn, is fake because our money, or what we call money, is not backed by gold or silver or anything tangible. This money is just paper, and we work so hard to earn this paper, while the government can just print this paper with the click of a button. If you want to see his explanation as to why he thinks money is fake, I will link that for you in the description below. But it's kind of hard to imagine that our money is fake, because this is the money that we use to pay our rent, to buy our food, and to buy our vacations. But the question that you want to ask yourself, especially now more than ever, is what are you working for? You say that you're working for money. Okay, but what is money? Is it that paper $100 bill that I have? Right now, at the time of me recording this video, the United States has right around $28 trillion worth of national debt, and we are on pace to hit $78 trillion worth of national debt in just a few years. Now, that probably just seems like a random big number because it's really hard for our brains to comprehend what $1 trillion is, so let me try to break it down. Let's assume that you can count $1 in 1 second. If you could do that and you wanted to count $1 million, it would take you 11 days. Now, that's probably not something you want to do, but you could do it. If you wanted to count $1 billion, it would take you just over 31 years. Again, that's definitely not something you'd want to do, but you could do it in your lifetime. But if you wanted to count $1 trillion, that would take you 31,000 years. That's not something you could do in your lifetime. Now, if we multiply that by 28, which is $28 trillion, the amount of national debt that we have, that means it would take you almost 900,000 years to count the amount of national debt that we have, and we're on pace to triple that in just a few years. So what is my good friend Benji really worth? No hard feelings, Benji. Well, money is supposed to be a representation of worth. If your time is valued at $20 an hour and you spend an hour at work, then you earn $20. That's also supposed to make spending money pretty straightforward, because if you want to buy a $100 scarf, that means you got to work for 5 hours to earn $100 to afford the scarf. The tricky thing now is that the value of our money can be manipulated. Back in the day, our dollars used to be tied to the value of gold. And let's assume hypothetically that an ounce of gold is worth $20. So if you put in an hour work and you made $20, you effectively made 1 ounce of gold worth of value. These paper dollars were really just a paper representation of how much value that you created that you could see through how much gold that you were entitled to. If you put in 1 hour of work, you're entitled to 1 ounce of gold. If you put in 5 hours of work, you're entitled to 5 ounces of gold. So this creates a benchmark of value, because not only does it take you time and effort and labor to earn that $20, but it also takes time and effort and labor to mine 1 ounce of gold. So it was a lot easier to define what $100 was worth, because $100 was worth whatever it took to mine 5 ounces of gold. But then in the 1970s, our dollar was taken off of the gold standard, so our dollars became just paper.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
That's when our dollars changed to something called fiat currency, and I'll just read you the definition of what that means. A fiat currency is a national currency like our dollar that is not pegged to the price of a commodity like gold or silver. The value of a fiat currency is largely based on the public's faith in the currency's issuer, which is normally the government. So this money that you're working so hard to earn is not backed by gold or silver or anything tangible. It's just a piece of paper that's backed by the government. Now, lucky for us, the United States is the most powerful country in the world. It has the most powerful military presence in the world, and it has the most powerful economy in the world. Before we go any deeper in this, let me just make sure this is clear. I'm not trying to promote any conspiracy theories. I just want you to understand how your money works. That way you can learn how to use your money the right way, because that's what financial education is all about, and that's what we talk about on our YouTube channel all the time. We talk about investing your money, saving smartly, and using your money the right way. Well, if you don't understand what your money is, then the financial education doesn't really have that much value. When your dollars are not backed by anything tangible, it makes it very easy to manipulate the value of the dollars that you're working so hard to earn. I'll show you what I mean. So let's go back to this example where now I'm working really hard to earn $50,000 a year. So this is me, and I'm going to work every single day. Gotta draw me a nice mustache. I'm going to work every single day so I can make $50,000 in a year. And let's assume, for the sake of this example, just to keep things simple, that there are only $500,000 in the entire world. So I worked really hard to attract and earn this $50,000, and there's only $500,000 in the world, which means I control 10% of this country's buying power of this dollar. So I own 10% of the wealth because that's what I worked hard to earn. Now here's the thing, if these dollars are just paper and the government comes out and they say, you know what, we're going to increase the money supply and we're going to change the amount of dollars out there from $500,000 to $1 million, they have just increased the money supply, and if I don't get any of that, now I don't have 10% of the world's wealth, I only have 5% of the total buying power or world's wealth, because the amount of dollars out there just doubled because the government decided to print more money and inject it into the economy, and unless I get some of that, I just became poorer because I have the same amount of money when there's more money out there. Now, if I wanted to go out and buy myself a side of extra guac that used to cost $5 when there was only $500,000 in circulation, I'm gonna need $10 in order to buy the same side now, because you need the same kind of percentage, the same amount of wealth, the same amount of value in order to buy that guac, because now there's so many more dollars out there. It might sound like a crazy example, and yeah, it's a little bit simplified, but that's kind of how our monetary system works. Our money supply is controlled by our central banking system, which is known as the Federal Reserve Bank, and the Federal Reserve Bank has the ability to print money. So when you hear about things like the rising national debt, and you hear bailouts are happening, you hear about stimulus checks, what that means is the government is going deeper into debt to fund whatever it is they want to do, and in order to fund their debt, they're working with the Federal Reserve Bank to print this money, and then the Federal Reserve Bank gives this money to the United States government, and then the United States government then injects this money into our economy. Could you imagine if you had your own money printer? I mean, you could walk into the mall, go to the Gucci store, and see that $400 scarf and say, oh no, I don't have $400. Let me just print a few $100, boop, 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 $400 come out, now you just got yourself a new Gucci scarf. You and I, unfortunately, don't have the ability to do that because we have to work to earn this money, but the Fed can just print money. This money printing does have consequences, because now you need $2 to buy you what $1 could before. This is what inflation is. This is why your rent keeps getting more expensive. This is why your groceries keep getting more expensive. You need more dollars to have the same buying power that you had before. In the beginning of this video, I talked about why traditional financial planning methods, like just saving all of your money, is not such a good idea anymore because of all the money printing that's going on. And that's because now, as more and more money is printed, savers become losers, because the value of your savings keep going down, because each dollar cannot stretch as far. As more money is printed, the buying power of each dollar that you save goes down. If you work really hard and you live below your means and you save $10,000 to help fund your retirement, and you want to be risk averse and you don't want to invest this money, so you save this money in your bank, that way you know where this cash is, well, the $10,000 that you save isn't going to have the same amount of buying power when it comes time for you to retire. Like if you saved $10,000 back in 1970, that $10,000 in 1970 would have gone way further than it will today. Like today, you would need about $70,000 to buy what $10,000 could back in 1970. So you save this $10,000, but each and every day, the buying power of the $10,000 is slowly dropping. Now, practically speaking, this doesn't mean that you shouldn't save any money. There is value to having savings, and I'll get to that in just a minute, but you need to understand what this really causes. So when the Fed prints money, they need to get it into the economy. And there's a couple ways that they can do that. So the Fed is printing some money, and the first main way that they get this money into the economy is by giving this money to banks, because banks are really involved in the money supply, and so if banks have more money, they'll be able to lend more money. The second way that you can see this money injected into the economy really only happens during crisis times. This is what you saw happen in 2008 and during the 2020 recession, where money can be injected into people through stimulus checks, or it can be given directly to companies through bailouts. So one way this money gets into the economy is through banks, and the other way is through a direct payment either to people or to businesses. But let's dive a little bit deeper into this. So interest rates are cut and banks have all these incentives to lend more money. So what happens? Well, you see two types of people. You see people like, number one, who go and borrow money, and then they go out and they buy assets. So these are people that are going out borrowing money from the bank at low interest rates, and they're investing this money. Maybe they're buying businesses, they're investing into real estate, whatever. They want to get this money from the bank. That way they can make themselves richer. The other type of people, let's call this person number two, they use this money from the bank to make them broker. They're buying liabilities. So now you have these people going to the bank with all this newly funded money, and they're borrowing this money to buy a new wardrobe on their credit card, or they're buying themselves a new car, or they're buying themselves a nice fancy vacation. So now they're making money just for the bank, because they're borrowing money, buying things that don't make them any money, and now all this money and this interest is going back to the bank while leaving this person broke. Now watch this. There's a bigger pool of money in the world because there's more money that was printed, and this person is using this money to buy more assets. They're buying things that make them more money, and so they own a bigger share of the entire kind of money pot, while this person is spending all their money to buy things that lose them money. So if you even just had the same amount of money as before, you're effectively poorer than before, because now there's all this other money out there and you don't own any of the other money because you use all your money to buy things that lose you money. So this person is owning a bigger share of the pot, while this person is owning a smaller share of the pot because more money is being created, and this person buying assets is buying the things where all the money is going, and this person is the one paying for all of these assets to grow. So now you're seeing a bigger divide between the rich and the poor because the people that understand money are the people that are buying assets, and all this new money is flowing into the assets, while the people that don't understand money are effectively becoming poorer because even if you have some savings, your savings are not stretching as far, and if you have a job, your earnings are not stretching as far, and all of your money is going out back to the bank because you're not using your money to buy something that's actually going to make you wealthy. You have all your money going out. But it gets a little bit worse because watch this. Now when you have these direct payments, it's going to go either to a business or it's going to go to a person. So a person would be through a stimulus check, a business would be something through a bailout. When a business gets free money through a bailout, guess who wins? It's the person who is investing in the business. It is not the average person unless you're working for that company. But in general, if a business is getting bailed out, the people who are winning are the people who own the business, and I guess the people that work there because they continue to have jobs. So this helps the asset owners, the people that understand money. The person who gets the stimulus check, what do? Well, they take this money and then they walk on over to Amazon, or they go to Walmart, or they go to Kroger, or they go to Lululemon, or they go to Apple, or they go to Chipotle and buy themselves some extra guac. So you take this free money and you spend it back here. I'm gonna draw this kind of a convoluted way, back at the businesses. So you made this free money, this more money was injected into the economy, you got it, and then you give this money to the businesses. Now when the money goes to the businesses, guess who's winning again? It is the asset owner, because when you own assets, you are the one making money when everybody else is spending money. And so now what's happening? You have all this more money that's created, all this more money that's printed, it's injected into the economy. Now you have way more dollars out there, but more of these dollars are getting funneled to the top, to the people that understand money. Because now when people make money, or when people get this free money, they spend it. And where do they spend it? At businesses. So now businesses have a bigger share of the pot because there's all these dollars out there, and all these dollars flow into the businesses, and people are spending all their money at businesses. So now businesses have a bigger share of the pot, and the people that understand money are the ones that are really benefiting because they're owning the assets. They're the ones that own the businesses. They're the ones that are investing in the businesses. They're the ones that are investing in assets where the money is flowing, versus the people that don't understand the system are becoming poorer and poorer because now, even if you have the same amount of money as before, it's a smaller percentage of the pot, so you're effectively becoming poorer because you don't own as much as you did before. Now your dollars don't stretch as far, your savings aren't as powerful, and your earnings don't buy you as much as they did once before. Now going back to the whole idea of saving money, we are seeing the lowest interest rates in the history of time. Now that's good news if you're a business or for somebody that's using this money to now make yourself more money. And it's, I guess, good news if you're this person because now your debt is a little bit cheaper, but in reality it's really not so good news because that means you're just becoming poorer because you're using more of your money to buy liabilities because you think you're saving money when in actuality you're actually just becoming poorer. But the real issue now is if you're saving your money, you're not getting any return on your savings because banks, when you have lower interest rates, banks pay you less interest on your savings. So when interest rates go down, yeah, you get a lower interest rate on your mortgage, which is nice. You get a lower interest rate on your credit card payments, which might be nice. But the issue now for your savings is your savings aren't growing either. Your savings are still, they're flat, they're dead. They're not doing anything. And so when you save $10,000 in the bank, after a few years, your $10,000 only earned you a few pennies. Let me diagram what this means. So here are your savings over time. Your savings are flat, they're dead. They're not growing because banks are not paying you any interest on your savings. But at the same time, the price of everything around you, your rent, your groceries, your healthcare bills, your vacations, everything else keeps going up because of inflation. We just talked about this. As more money is printed, the value of your dollars go down, which makes the price of everything around you go up. This is not a secret. This is public information. The Fed is openly saying that they're working hard to increase inflation. And so when they say they're trying to increase inflation, that means they're working hard to print more money to make the price of things go up. while at the same time, you know that your savings are not growing at all. So your savings are dead, the price of things keep going up, which means if you're saving all of your money, you are effectively becoming poorer because your money's not doing anything while the price of everything keeps going up. So what does this mean for you? Before I get a whole herd of comments of everybody saying, "Oh, Jasprit, are you telling me not to save any money?" Let's get this straight. Saving your money is important. You need to have an emergency fund. You need to have savings to protect you from an emergency, but you need to understand why you're saving your money. Saving your money is important as a financial cushion to protect you from you losing your job, from a financial hardship, from a crisis. That's why your savings are there. Your savings are there to protect you from going into debt when something goes wrong. If you want to be a small saver, then your goal should be to save something around 3 months worth of expenses. If you want to be in a good saving spot, then you want to save about 6 months worth of expenses. And if you want to be an aggressive saver, then your goal should be to save 12 months worth of expenses. So if you're spending $3,000 a month, just calculate it out. Now, what you need to remember is why you're saving your money. Your savings are not there to make you wealthy. Your savings are there to protect you financially. Once you have your savings locked, now you need to really be investing your extra cash because you want to be on the winning side of what's happening financially. This could mean investing in real estate or businesses or stocks or commodities. It really just depends on what your investing goals are and what your risk tolerance is. The whole reason you want to be investing your money is because now you want to be the person that's owning the assets. So if more money is printed, this money flows into your assets, which makes the value of your assets go up because of inflation. And now you're on the winning side of inflation. That way you're not getting abused by the financial system. So the gym that I go to has this little TV area in the front of our locker room, and I was getting ready to leave, and as I'm leaving, I saw on TV that there was this infomercial on where this guy was teaching people about how to build wealth. Obviously, I wanted to see what this was about, so I sat down to see what was going on. This guy was talking about the powerful value of having a good credit score, and he was saying that little things like one missed payment can really hurt your credit score, and so he was promoting his business, which helps people improve their credit score. Nothing out of the ordinary so far, right? The interesting thing was that this system that he created to build your credit score is a way to help you build wealth and become wealthy. And as you could probably imagine, I was pretty confused when I heard that. Improving your credit score makes it easier for you to get more consumer debt, but relating that to wealth building didn't really add up. But luckily, he brought on some testimonials to answer the questions that I had in my mind. And so 3 or 4 people came on the air and they said things like my credit score was screwed up because I missed some payments or I had a divorce or some other thing like that. And then they went on to say that after they had their credit score fixed, now they could go out and buy all the luxuries that they couldn't 6 months ago. And now they can travel a lot more, all because they fixed their credit score. And in case you're like me and you're scratching your head wondering how that makes any sense, let me explain what happened. If you improve your credit score, then you can have easier access to more debt and you can get lower interest rates on some of your loans, right? Pretty reasonable so far. But now, according to this infomercial, once you have this easy access to debt, you will be able to buy all those luxuries that you wanted, and you'll be able to go on more trips by getting a loan for these things. And being able to finance all these nice things is what makes you wealthy. You know what this calls for? One of these. Hearing this on TV in the sacred gym where people go to turn their dreams into gains obviously made me want to make a video on this. Let me start with this. Having easy access to lots of consumer debt, which is debt that you use to buy things that don't pay you, like your boat and your cars and your house and your vacations and your clothes, does not make you wealthy. What? Owning a lot of luxury and name brand things that you have to pay to keep every single month doesn't make you wealthy. What? And having a $100,000 monthly limit on your credit cards doesn't make you wealthy either. What? Wealthy means you can do what you want and buy what you want without worrying about how you're gonna pay for it because you know how to live below your means and you have income coming in to support your lifestyle. So, believe it or not, the person who owns a beat up and used and completely paid off Toyota Camry with $2,000 a month in passive income is wealthier than the person who owns a nice Lamborghini, who has to pay $2,000 a month to keep it, who has no passive income, who has no investments, and who has no money left over after paying off all their expenses every single month. What you own does not make you wealthy unless it's putting money in your pockets. And that's why, unlike what the majority of people believe, your house and your car do not make you wealthy. You have to pay to keep them, you have to pay to maintain them, and they're not paying you to use them. Consumer debt is an expensive tool that makes the banks richer and it keeps you broke. Period. Financing a big new boat isn't going to make you wealthy unless you're using it to generate income, like by renting it out. When you keep buying things that don't pay you, that you cannot afford with money that's not yours, you get stuck in the cycle of constantly playing catch up by trying to pay off all the things that you have, so you never have a chance to actually build wealth and get ahead. Now look, I'm an entrepreneur. I understand that businesses have to sell things in order to make money. That's how business works. And there's nothing wrong with buying luxuries, but you have to make sure that you can afford it. And that's why I'm gonna hammer this home. If you're using debt or a line of credit or financing to buy things that you don't need, that you can't afford, and that don't pay you, it's going to cost you a lot. According to the simple dollar, if you live in America and you have an average amount of debt, you will likely be paying something around $8,000 a year in interest payments to pay for the things that don't pay you. The number one reason why the majority of people will never become wealthy is because they get stuck in this cycle of constantly trying to pay off what they own and maintain a certain image by buying all the newest and nicest things, and so you never have the chance to get ahead or build your wealth because your money is always going out and nothing is coming back. And that's why it's so ironic that this infomercial is telling you that they can make you wealthy by giving you easier access to bigger homes and cars and boats and more vacations. It doesn't make any sense. That is why it is so important for you to learn about money and be financially literate. This way you don't fall into these traps, and this way you can understand the difference between something that takes your money and something that makes you money. The holidays are here and debt is in the air. I'm a summer person and I live in the northern part of the United States, which means winter means cold is coming, and I like looking at snow, but I'm not a big fan of the cold. Do you know what else people do when it's cold outside? They shop. Well, okay, maybe people don't shop because it's cold outside, but these colder months, the end of the year, is when you have Black Friday, Cyber Monday, and all the holiday shopping that happens. This is a big deal because 2 out of 5 Americans feel that they have no choice but to go into debt during the holidays. It's almost as if living within your means is something peasants do. Did you just tell me I can afford that sweater? I don't want it. One of my friends had this diet where he would only try to eat less than 1,700 calories a day, but he had this thing where if he accidentally splurged and he ate more than 1,700 calories, then he would go out and eat everything he can because now this day is already gone. He already lost his diet this day, so might as well eat everything you can, and so it wouldn't matter how many calories he ate that day. But a few months into it, he realized, wait, if I go over the 1,700 limit and I go and eat everything I want, it's not like these extra calories that I ate just kind of like disappear after midnight. They don't just restart. Those calories stay in your body. It's a lot better to eat only 1,750 calories and say, oh man, I went over a little bit, than saying, oh, I ate 1,750, so I might as well go out and eat 3,000 calories because my next day's limit doesn't start till after midnight. It's the same with holiday debt. Holiday debt carries over into the new year. It's not like it just goes away, and lots of Americans are still paying off last year's holiday debt, and every year the amount of holiday debt that you have just keeps compounding. But it does not have to be that way. Magnify Money did a study, and they found that in 2019, millennials took on an average $1,215 of holiday debt during the 2019 holidays. Now, if you think that was bad, take a look at this. In 2019, Generation Xers spent a whopping $2,076 they did not have. This is how much holiday debt Generation Xers took on average. Let's do the math on this, okay? Let's say you take on $2,000 of holiday gifts. This way you can have cool gifts for your friends and family, and you put this money on your credit card. Your credit card's probably gonna charge you something like, what, 18% a year in interest, and so that's gonna cost you, if you just do the minimum monthly payments, $50 a month. So assuming you only pay the minimum monthly payments of $50 a month, you are gonna have to pay $3,077 to pay off this $2,000 worth of holiday gifts that you thought would make you look really cool. I should also mention that if you only make the minimum monthly payments of $50 a month, it's going to take you 5 years to pay off this holiday debt. So if you take this holiday debt in the year 2020, you're going to be debt-free on your 2020 holiday debt in the year 2025. So this assumes that you don't take on any more holiday debt in 2021 or 2022 or 2033 or 2024. So if you do that and you only make the minimum monthly payments, it's going to cost you $3,000 to pay off your 2020 holiday debt, and it's going to take you 5 years to do that. You can clearly see the problem here. The holidays were meant to be a happy time. It's not supposed to be the time where you go and become broke. I know it's easy for me to say this behind the screen, especially since I'm a member of the Sikh religion, so I don't celebrate Christmas or Hanukkah or Kwanzaa, so I don't have the same gift-giving pressures that other people might have. But what I do understand is how money works. And what I know is if all of your money is going out to buy gifts for other people, you will never have the chance to become wealthy, and you will never have a shot at being rich. Once you're wealthy and once you're rich, buy your friends and family whatever gifts you want. Buy them bigger gifts, buy them nicer vacations. It doesn't matter, because now you can afford it without stressing about it. But in order to do that, and in order to get to that point, you have to build that wealth first. So I want to talk about other ways you can save money during the holidays, but I just pulled up my calendar on my phone, and it looks like the holidays are actually going to be back again next year at the exact same time. If you don't have the money to buy all the nice gifts and stuff this year, don't. Okay, the holidays are going to be back again next year. And if this makes you feel really bad and guilty because you can't buy all the stuff that you want, start saving this year for next year's holidays. Buying someone an expensive sweater will make them happy for a weekend, but the pain of your debt for spending money you don't have will last you years. Your goal right now is to build wealth. That way you can buy the things that you want without stressing about the price. Now, getting to the point where you never have to worry about money again isn't going to happen in 12 months. But it will never happen if every time something comes up, you have to empty your bank account, because guess what? Things are gonna keep coming up. You have holidays, you have birthdays, you have weddings, you have baby showers. There's 1,000,001 reasons for you to hand your money away. But you need to remember the one reason why you need to keep your money in your pocket right now: wealth. And you will never achieve this type of wealth if every time something comes up, you have to give all your money away. There are 2 words that I need you to understand. And if you're subscribed to our YouTube channel, you've heard me talk about this before. And if you're not subscribed to our YouTube channel, make sure you do that. But you need to understand assets and liabilities, okay? Assets are things that put money into your pocket, and liabilities are things that take money away from your pocket. If you want to build wealth, you need to be buying assets and buying less liabilities. This is what the majority of people spend all their money on. So this is clothes, cars, shoes, gifts, anything you're spending money on that's not putting money back into your pocket. This is a liability. Assets are investments. So these are things like stock investments, real estate investments, things that you're buying for the purpose of putting more money in your pocket. The majority of people are spending all their money buying liabilities, and then they wonder why they're broke. But this is the interesting thing. When you spend your money on liabilities, it's a liability for you, but it's an asset for somebody else. Like when you go out and you buy Apple AirPods or something, that's a liability for you, but it's an asset for Apple, because that's making Apple rich. When you go out and you buy those Lululemon leggings, it's a liability for you. It's taking money away from you, but it's making Lululemon rich. When you go out and you shop on Amazon for things you don't need, you are spending money on things you don't need, a liability, but it's making Amazon rich. So this money that you're spending, it's making somebody rich. It's just not making you rich. The whole world loves it when you spend your money here. Banks love it, companies love it, even my stock portfolio loves it. But this is the reason why the majority of people are broke, is because they're living their life here. They're spending all their money on liabilities, and they have none of these assets. Now, I'm not saying that you should not buy any liabilities. Everybody needs a car, everyone needs clothes, and you should be striving to buy nice stuff if that's what you want. There's nothing wrong with that. But you need to make sure you can afford it first, and the only way you can do that and build that wealth is if you buy these assets first and then buy the liabilities when you can afford it. So if you want to become wealthy, the solution is actually pretty simple. Spend more of your money buying these, and when you get this money from your assets, use this money to buy these. Now you're building your wealth first, and then you're buying what you can afford. It doesn't have to be stressful. You can make it a game, make it fun. You can follow our 5-to-1 rule. For every $5 you spend buying liabilities, spend $1 buying assets. So if you go out and you buy $100 of Apple stuff, spend $20 buying Apple stock. Now, the more you spend, the more you're forced to invest. And now you're not just forced to live below your means, but you're forced to live below your means. That way you can buy more assets and build more wealth. Now, while I'm on the topic of holiday spending, let's also get into kind of the secrets of holiday sales. You know, when you go into a mall during the holiday season and you see those big red signs that say 40% off, come in and shop now. Well, there's a couple things that you need to know. A sale only saves you money if you're buying something that you're already gonna buy. If you go into the mall to buy a pair of jeans and then you walk out with a pair of jeans and a t-shirt for $20 that was 60% off, you didn't save $30 on a t-shirt. You spent $20. You gotta get your mindset right about money. If the original price of a shirt is $50 and it's on sale for $20 and you buy it, you are not saving $30, you are spending $20. And the second thing you need to understand, let's call it a secret because lots of stores don't want you to know this, is sometimes, not every time, but sometimes when that t-shirt goes on sale, sometimes the store will actually hike up the price of that shirt just so they can mark it down with the sale. Look, let's look at this honestly from a marketing perspective, okay? A $20 shirt isn't very attractive from a marketing angle. But if I take this $20 shirt and I mark it up to $50 and then I slap on a 60% off sign and then I sell it to you for $20, I'm still selling it for the same price, but you feel like you're getting a steal because you're buying a $50 shirt for 60% off for $20. But you're actually just paying regular retail price. Jasprit, what do you know, man? No, I know. I'm just a random guy on YouTube, so what do I know? But if you don't believe me, you can believe JCPenney or Macy's or Kohl's or Sears. They were all sued because of this type of deceptive marketing strategy where they would raise the price of their clothes just to mark them down for big savings. Or so you thought. Money is a game. The whole world wants you to spend it. You need to put up a filter and understand what's worth spending money on and where do you build your wealth first. That way you can afford to spend your money on all the things that you want. This is what financial education is all about. Using your money to build your wealth before you use your money to make everybody else rich. The banking industry is one of those industries that makes more money off of you and other people when you do not understand money. When you spend money that you don't have, buying things that you don't need, that do not pay you for owning them, well, now you're going to be going to the bank to borrow all their money, and then you're going to spend the rest of your life paying off all the things that make you look rich, but they keep you broke because all of your money is going straight to your bank. Now, as soon as you get paid, your bank is the first person to get paid, not you. But that's nothing new. Banks have been skinning people alive financially for generations, but banks also do have a purpose. Like banks let you have a savings account and a checking account, and banks are the go-to place for you to borrow money to buy a home and maybe even a car if you believe in financing your car. But when it comes to building your wealth, there are certain secrets that your bank does not want you to know because these are things that will make you money, but they don't make your bank any money. You gotta start by understanding how your bank makes money, and there are 3 general ways your bank makes money, at least at the consumer level. There are other ways your bank makes money, but let's focus on these 3. Number 1 is your bank makes money when you give them money. Second, your bank makes money when you spend money that you do have. And number 3, your bank makes money when you spend money that you do not have. Let's start with this. When you give the bank your money, when you give your bank $100 that you want to deposit in your checking account, what happens? As soon as they give the bank this $100 bill, they're going to turn around, put this in their system, boop, 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 that we got another $100, and immediately they're going to do whatever they can to lend this $100 out. You get a receipt saying that you deposited $100 and that you can withdraw this $100 whenever you want, but the bank, as soon as you deposit this $100, is going to turn around and they're going to lend this money out to somebody else. So maybe your cousin Bunty can go out and buy himself a new wardrobe, buy himself some food on his credit card using the bank's money. The more money you deposit in the bank, the more money your bank is going to make, because as soon as you deposit your money in the bank, your bank is going to lend this money out to somebody else and they're going to charge this person 3, 4, 5, maybe 20% interest because they're charging crazy interest rates on credit cards while they pay you next to nothing in your savings account. So when you deposit money, your bank is paid and you get the peanuts. Now that your $100 is in your bank account, your bank will also get paid when it comes time for you to spend your $100 thanks to the help of plastic, things like credit cards and debit cards, because when you go to Walmart or you you go to Chipotle and you go and you spend your money, you swipe with that plastic, your bank is going to charge Walmart or Chipotle a fee to process this transaction. So Walmart or Chipotle are going to have to pay your bank a 1% or 2% fee every time that you swipe your card, and that's money your bank makes when you're spending money that you do have. The fee that a company like Walmart has to pay to process your debit card is less than the fee that it has to pay to process your credit card, but it really doesn't make that much of a difference to you, because whether you're paying with a debit card or a credit card or even with cash, you're still going to be paying $100 if you're buying $100 worth of groceries. The only time your bank doesn't make money when you spend your own money is when you buy things with cash, unless you have to pay an ATM fee to access your own cash. But it really doesn't make sense to buy things with cash if you can use a debit card or credit card, because this fee that your bank gets doesn't really affect you. That's something that the company has to pay. And if you use a credit card, you also get perks and cash back and rewards, which is why I only use a credit card. And if you want to learn more about why, I'll link a video where I explain that in the description below. If you're buying $100 worth of groceries from Walmart, it doesn't matter if you use a credit card or a debit card or cash, it's going to cost you $100 each way. Sure, Walmart might save some money if you pay with cash instead of a credit card, but on your end, it really doesn't matter because it's going to cost you $100 each way, assuming you know how to use a credit card and you don't buy things that you wouldn't buy normally with cash with a credit card. And so if you know how to use a credit card the right way, you're just going to get some more perks and benefits for using a credit card instead of using cash, because it's going to cost you the same amount of money. But things really change when you spend $100 at Walmart buying groceries when you don't have $100, because now your bank is going to get paid from Walmart, because Walmart has to process your credit card transaction. And if you don't have $100 in your account to pay your credit card bill, now you're spending the bank's money, and the bank is going to charge you an insane interest rate, because now you got to pay interest on your credit card balance. It is your bank's dream to spend a whole bunch of money that you don't have and just spend this money using the bank's money, because that means you're going to be in debt for the rest of your life, and anytime you get paid, your money is going to be going straight to the bank in interest payments, leaving no money for you, which is good for the bank because now they're making all this money through interest. But it's not so good news for you, because now you're in debt for the rest of your life and you have no money to build yourself wealth. Even if you stay away from debt, if you spend money you don't have with your debit card, then your bank is going to charge you an overdraft fee, and so you still got to pay money for using money that you don't have. That's why banks made something like $11 billion in overdraft fees back in 2019. That's why the less you understand about money, the more money your bank makes, and we're going to turn that around. That way you can be the one making money, not just your bank. So now that you understand this, what can you be doing with your money that way your bank isn't the one making all the money? Well, the first thing you got to do is you got to get your money out of the bank, and there's an asterisk here because I want to make sure you understand what I mean. When you put your money in the bank, you deposit your money in your checking account, your bank is going to turn around and they're going to lend your money out to everybody else, everyone that they can get their hands on. That way the bank can get rich while you get nothing, because your savings account, your checking account is sitting here. It's flat. Well, anytime you deposit $1 in the bank is going to loan it out, and they're going to charge somebody 2, 3, 4, 5, or 20% interest depending on how they loan the money out. So the first thing you got to do is you got to stop letting the bank lend out all your money, and you got to be the one getting that return on your money. Now, there's a little asterisk here because you got to understand when and how much money to keep in the bank. So I have a few different bank accounts. I have a checkings account, which is where I spend my money out of. This is what's linked to my credit cards. So anytime I spend money, it's linked to my checkings account, and my checkings account pays for all my bills. I make sure that my checkings account has enough money for at least a couple months of expenses at any given time. But then I also have a couple savings accounts. I have a high interest savings account, which is where I keep my savings fund. This is where I keep my emergency cash, because you always want to keep somewhere between 3 to 12 months worth of expenses in a savings account liquid. This is money that if an emergency happens, if you lose your job, or if your kid gets hurt, or something goes wrong with your car, you can access your savings account money whenever you want. This is money I keep in a high interest savings account because this isn't money that I'm really touching, and I'd rather have this money grow faster than it would at a traditional bank account, so I keep it at a high interest savings account. And then I have another savings account, which is where I keep some cash that I want to invest, usually for real estate. And so anytime I got some extra cash, I put it in here. That way I can use this cash to go out and buy real estate with. I keep money in the bank that I need to spend in my checkings account, and I keep money in my savings account for emergencies. And then anytime I got extra cash, I want to get this money out. So the other savings account that I have to buy investments with, once I have enough cash in there, I'm going to use that cash to go buy something else. I'm going to go buy an investment property, and that way I take my money out of the bank, because my money in the bank isn't making me any money. It's making the bank money, but it's not making me any money. I also have an automatic withdrawal withdrawal, which goes into my stock market investments because I don't want to keep too much money in the bank. I understand I got to have my money in my checkings account because I got to buy things. I got to have money in my emergency savings account. That way I'm protected from an emergency. But everything else, I want to get out. Your bank doesn't want you to know this because if you start taking your money and you move it into the stock market, or you move it into real estate, or you move it into cryptocurrency, you move it wherever, you get it out of your bank account, your bank is not happy because now they have less money that they can lend out and they have less money that they can make money off of because now you are the one making money. Because when you take your money out of the bank, assuming out of your checkings account and out of your savings account, your emergency savings, you take your extra money out of the bank and now you're putting it to work. That way it can make you money. Because when all of your extra cash is in the bank, then your bank is using your money to make the bank money. I want you to use your money to make you money, which is why you got to get your extra cash out of the bank. Once you start to take your money out of the bank, don't be surprised if your bank looks at you a little bit differently. Like the first time I moved my money, my savings, to a high interest savings account outside of my traditional bank, I had a meeting with my bank manager over there. And she was not very happy because I was moving a sizable chunk of cash out of the bank to a different bank that was paying a higher interest savings account. And she was pretty upset. I mean, very visibly, because I was moving this money out of this bank to another bank and the money was leaving this bank. So now they had less money that they could use to lend out to other people. And she called up a different bank manager and they both tried to convince me to leave my money in this bank and not take it out and move it to another bank that was paying me a higher interest rate on my savings. And so when you take your money out of the bank, now your bank isn't making money, but you got to use it to make you money. Now, I understand a high interest savings account isn't really going to make you money in the sense of beating inflation and as an investment, but as you start to take your money out of the bank to buy assets and investments, which are things that pay you for owning them, your bank is going to be the one that's losing money because now they don't have all the extra cash that they can lend out to other people, and so now you are the one making money, not your bank. The second thing you got to do is you got to stop financing liabilities, because when you're financing liabilities, you're paying interest to own something that's losing value. And who's the one getting rich when you do that? It's not you, it's your bank. Liabilities are things that you buy that don't make you any money. These are things like cars and shoes and clothes. These are things that make you look nice if you have a bunch of nice liabilities, but they don't make you any money. They keep you broke. And the issue here is we live in a culture where it is completely normal to finance your cars, completely normal to now start financing your clothes because of things like Affirm and Afterpay. And so we're entering this really debt-heavy culture where it is completely normal to just finance your everyday lifestyle. But when you do that, the person that's getting rich is not you, it's your bank. Because now you're spending all your money trying to buy a whole bunch of nice things that make you look rich, but you're going to spend the rest of your life paying these things off, when what you should be doing is using your money to buy things that will pay you instead of just paying your bank. The reason why this is so hard for so many people is not because of the looks you're going to get from your banker, it's because of the looks you're going to get from all of your friends when you stop having a nice car, when you stop having all the nice clothes, because now you're buying everything with cash. And so people don't get to see all the Gucci stuff, they don't get to see the fancy car, they just see you driving things that you can afford with cash, which isn't as attractive as buying things with the bank's money. Now, there is a time and place when it makes sense to use the bank's money. Like if you wanted to buy a home, sure, go out and get a mortgage, because most people don't have $500,000 sitting in their bank account to go out and buy a home. But if you want to actually use the bank's money, you can use it to buy something that's going to make you money instead of just buying liabilities, which are things that lose you money. The most common example of this would be buying investment real estate, because now if you can go out and borrow some money to buy a home or an apartment complex that you can rent out to other people, now the goal is the people that are living in your property are going to pay your bills, they're going to pay your taxes, your insurance, your maintenance, and they're going to pay your mortgage. And on top of that, there should be some money left over to go into your pocket every single month. So this is a passive investment that you don't have to really work to earn the money on, because you have the tenants that are paying your rent, and your tenants are the ones that are paying your mortgage, and they're putting some money in your pocket every single month. If you are using the bank's money to buy an asset which is making you money, then sure, it makes sense. But if you're using the bank's money to buy liabilities which are keeping you broke but making your bank rich, then it doesn't make sense, because right now your goal should be to build your own wealth, not to make your bank rich. And the third and final thing that I want to mention on this is that your bank and your banker is not your financial advisor. It kills me to see this when people go to their bank and they ask them, how do I spend my money, and how big of a home can buy, and how much money should I borrow? It's like going to an insurance person and asking them, how much insurance can I buy? Your insurance person is always going to tell you more. Your insurance person's job is to sell you insurance, and so they're going to want to sell you as much as possible. Your bank's job is to lend you money, and so their job is to get you in debt and to keep you in debt for as long as possible. It is not your bank's job to look out for your financial wallet. It is not your banker's job to make you money. Your bank is just trying to make money for the bank, and so you gotta understand how to use your money the right way and understand who's on your side financially and who's not. If you do want to talk to somebody about real financial advice, talk to a financial advisor, talk to an accountant, talk to somebody who's going to be working on your side to help you build your wealth, because your bank's job is not. We went through a worldwide health crisis and we went through a worldwide recession, and yet you have some people, the rich people, who became now significantly more rich, while you have the majority of the world, average people, who are now poorer than they were before. Regular people are struggling to pay their bills. Regular people are struggling to pay their rent. Regular people are struggling to buy groceries because everything is way more expensive, while you have some people that just keep getting richer. Now, before we go any deeper, I do want to give you a little bit of a trigger warning, because if you're easily triggered, you probably don't want to watch this video. So this is you right here. You are this good-looking person. Let me draw you a nice mustache. And for our female followers, let me draw you right here and draw you a nice braid, or as we like to call it in my native language, Punjabi, a gut. You are in this situation right now. And we are in a world where the rich are getting richer, the poor are getting poorer. Now, this is not new, but the pandemic had accelerated this. Now, the rich are getting richer faster, and the poor and the middle class are getting poorer faster. Now, at this point, you have two options. Either you can play the blame game, get mad at the rich, hate it, hate the system, complain, cry, or you can do the learn game, and you can say, what is going on in the system? How can I learn how the rich have become rich and how they are getting richer? That way I can benefit from the system, because now you want to capitalize on what's going on. So I can't tell you which one you should play. But if you want to be the person playing the blame game, you want to complain, you want to cry, you want to hate the system, you want to hate everything, well, then you can just hit that X button on this corner or this corner and just leave this video, because in this video, we're going to be talking about the learn game. Because the reality is the rich are getting richer, and this pandemic has accelerated that. And the rich are going to continue getting richer at a faster rate. So either you can get with the times, understand what's going on, learn what the rich are doing, that way you can become rich and then stay rich, because you need to understand what's going on now more than ever. Now, I want you to listen to me very carefully here, because in 2020 and 2021, the United States government printed 40% of all of our money in existence right now. In just those 2 years, we had 40% of all of our money that we have in existence, that paper dollars, our cash, 40% of it was printed in 2020 and 2021 with the goal of trying to help poor people, middle class people survive through this pandemic. And what did it do? Well, it gave the poor and the middle class a little bit of a boost, but then it ultimately made rich people richer. Because now we are in a position where the rich and the wealthy are significantly richer now than they were before the pandemic. And at the same time, the poor and the middle class are now poorer than they were before the pandemic. Why? The government printed this money with good intentions, or at least that's what we want to believe. They wanted to help the people, they wanted to help the average person, so they started printing money with the goal of helping regular people, the middle class and the poor, have a chance to survive and maybe even thrive through this pandemic. So what they did was, well, some of this money went out in the form of bailouts, some of this money went out in the form of welfare, and then some of this money went out in the form of stimulus checks. So the government took this money, they printed it, and then they started giving it to people and businesses. Well, then what happened? Well, you have these people, the people that took this money. They got this money because they didn't have any savings. You didn't have much savings, you didn't have investments to fall back on. So now you needed cash because the whole world was slowing down. You didn't have an income, and now you needed to pay your bills. You had to pay your rent, you had to pay your groceries, you had to pay for your electricity, because that way, you needed some money to keep the heat on. So now you take this cash, and then you go to the store. What do? Well, now you take this money, you go to Walmart, or you go to Amazon, and then you go shopping. And then you start buying your groceries. And now what are you left with? Well, you have some groceries, but you have no money. But Amazon and Walmart, well, they sold you the goods. They sold you the groceries. So now what do they have? Well, they sold you a product and now they have bigger profits. Amazon, the company, brought in record sales during the pandemic because people needed to shop. They don't want to go into the grocery store, so they started shopping online. So who benefited? Amazon and the owners of the company of Amazon, the shareholders, because now they made bigger profits and their stock price skyrocketed. Now at this point, you're probably going to say, but Jaspreet, people needed groceries, they need food, they needed things. What do you want them to do? Not shop, not eat? Well, you smart person, I'm glad you brought that up because it wasn't just Amazon that benefited, luxury brands benefited too. Gucci saw a massive amount of sales in 2021. In 2021, we were still in lockdown for the first half of 2021. In 2021, we were still in a recession. In 2021, people were still not working. We were seeing record unemployment rates. And yet, we were seeing record-breaking luxury sales at Gucci. Gucci was seeing sales, the same sales they were seeing before the pandemic, in the middle of a pandemic. And it wasn't just Gucci. Louis Vuitton, LVMH, the company that owns Louis Vuitton, saw record-breaking sales of their luxury items in the middle of a recession. We were in one of the worst recessions in the history of time, yet these luxury companies, Louis Vuitton and Gucci, were making record-breaking sales. Louis Vuitton was making money hand over fist. They couldn't even produce enough stuff to sell people because everybody wanted to take their money and go out and buy some Louis Vuitton. They wanted to buy some Gucci. People were willing to wait 2 hours in line. They were willing to spend 2 hours in the freezing cold standing in line to pay $6,000 to buy a purse. Let me diagram what this means because if you're a visual person like me, it'll make a lot more sense if you see it. So over here, we have the government. And then over here, we have the people, average people. So what happened was the government worked with the Federal Reserve Bank to start printing money. So they started printing this money right here and they started giving it to people. And then people became very happy because, hey, I got some free money. I don't gotta pay my rent, I don't gotta pay my mortgage, I got a stimulus check in the mail. The average person felt wealthier because now you had this free money. Now what happened for a lot of people, not everybody, but for a lot of people, the average person, they now took this new free money that they were making and they started spending it, even if they didn't need to spend it, because of course you had some people that didn't have any money, they couldn't eat, so they needed this cash to go out and buy groceries. But you had a lot of people that were continuing to work, that had money, that now didn't need to spend this money, they didn't need to go out and use this money to buy their groceries, they didn't need to use this money to pay for their electricity bill. So they took this cash and then they started spending it at these companies, these big corporations. And so now what you saw happen was money flowed from the Fed and the government down to people, and then it flowed up right here to the corporations, the big companies. And so here, when the government started printing money, remember, they printed 40% of all dollars in circulation in 2020 and 2021. What that did was it diluted the value of everybody's dollar. Not just the money that they printed, but all the dollars that you had saved in your account here, all the money that you were earning from your job, well, it's not worth as much. If you were making $25,000 before, well, that $25,000 isn't going to buy you as much. If you were making $250,000 before, well, your $250,000 salary isn't going to buy you as much as it did before. I mean, just look at the prices of everything around you. It's going up. Everybody keeps blaming supply chain issues, but if you're financially educated, you know it's not just supply chain issues, it's inflation at work. You're printing more money, you're diluting the value of the dollar, so the value of the dollar goes down. Well, money was printed, it went down here, everybody had some more cash, and then they spent this cash, it goes up to corporations, and now you had all these new dollars that were printed, and now where are these dollars being concentrated now? Well, it went down here, but then a lot of these dollars just flowed back up here. So now we have this imbalance of dollars. We have more dollars being concentrated up here than we do here because money flowed up to the top. Money flowed to the wealthy. And so now you have a bigger concentration of dollars here. And now the people here, well, you may or may not have more savings than before. A lot of people actually have less savings than before now because the cost of everything is so much higher. But let's just assume that you have the same amount of money in the bank now. You're making the same salary as before. Well, you are poorer now than before, even if you have the same bank account, even if you have the same job, because that money that you earned is now being concentrated here. And the dollars that you have saved can't stretch as far. Your groceries are more expensive. Your rent is more expensive. Houses are more expensive. Vacations are more expensive. Healthcare is more expensive. Everything in the world is more expensive now because the value of our dollar is worth less thanks to inflation. And so you have each people here who have this fixed income, you have a salary which isn't growing fast enough to meet inflation. And then at the same time, you have a bigger concentration of dollars up here at the top. And who does this benefit? Well, it benefits the rich. It benefits the wealthy. And it's not just the corporation. I mean, it benefits the shareholders. Anybody can be an investor in Amazon. Anybody can be an investor in LVMH, the company that owns Louis Vuitton. These are companies that trade on the stock market. And so the people that benefited were the people that invested their money or had their money invested through 2021. Because if you did, you saw a massive return on your money. And this inflation that we saw happen didn't bother you that much because your investments grew even faster than inflation. Now, if you're thinking something like, Jaspreet, that's really mean. It's not nice for you to say these type of things. It's hurting my feelings. Well, money doesn't have feelings. Money is not emotional. This is just what the system is, and this is what is happening. So you can either understand it and learn from it, or you can choose to be oblivious from it, or you can just cry about it and complain about it, right? Remember what I talked about in the beginning? My goal here is to teach you what's happening, that way you can benefit from it. So now we understand what's going on. Now, the to-dos, what do you do? There are three things that you need to do. First, you gotta get financially educated. Second, you need to be prepared. And third, you gotta get your money. So I'm gonna talk about these three things. Let me start by talking about number one, why financial education is so important. I didn't grow up learning about financial education. I grew up in a traditional Indian house. I was supposed to be a doctor. Growing up, doing anything that wasn't related to science or math or medicine was considered a waste of time. I didn't know what investing was. I didn't know what a dividend was. I didn't know what real estate investing was. I didn't know what this was until I started learning about it myself. And the reality is we live in a day and age where it doesn't matter how much money you make. It's what you do with the money you make. If you make $250,000 a year, but you're spending $300,000 a year, it doesn't matter that you're making $250,000 a year. It doesn't matter that you have a big salary. You are one paycheck away from broke. You can live this $300,000 a year salary with a $250,000 a year income thanks to the help of credit card debt, thanks to the help of loans and lines of credit and buy now, pay later systems. This is what so many people are doing. You assume that, hey, I'm making good money. Let me go live like everybody else. Let me go buy the nice things. Let me go buy the Gucci and the Louis Vuitton so I can show it off on Instagram. I want to get those likes. And you can do that. But if you continue to live like that, you will never have the opportunity to build wealth because what you're doing right now is you are spending your money to make everybody else around you rich. So what you need to do right now is first you got to get financially educated. You got to understand that, okay, I want to build wealth. I want to become wealthy myself. I want to be rich. I want to stop getting screwed over by the system. And I want to be the person that can now benefit from the system. Once you make that decision for yourself, now you got to get educated and learn how do you do that. The first thing you got to do is stop spending all your money. Because when you spend all your money, well, guess what? Everybody else around you is rich. When you're buying Gucci, Gucci is getting rich. When you're buying Louis Vuitton, Louis Vuitton is getting rich. When you go out and buying the BMW, well, the car dealership and the BMW company is getting rich. It's not you. You look rich, but you stay broke. So what you need to do is first stop spending all your money. Start downsizing. That way you have some extra cash that you can put towards yourself. Now it's time for you to start learning. Maybe you're going to start learning about how to invest your money. Maybe you have a job. You don't want to leave your job. You like what you're doing. You're going to learn about how to invest your money, how to make better use of your money because the cash in your bank is being eaten away by inflation every single day. If you have $1 million in the bank, well, that $1 million is losing about $70,000 worth of buying power every year right now. Because in 2021, we saw 7% inflation. That means the value of your dollar is going down by 7%. If you have $1 million in the bank, you might think you're rich, but it's not going to keep you as rich as you are today because $1 million is going to lose buying power each and every day. And if you say, oh, Jaspreet, inflation is going to cool down. When? They said that inflation was going to cool down by mid-2021. Then they said it's going to cool down by the end of 2021. Now they're saying it's going to cool down by the end of 2022. But we have no end in sight yet. So don't keep waiting around. Don't wait for the Fed and the government to take care of you. Take care of yourself and stop keeping all of your cash in the bank and start understanding what you can do with your money. So now you get educated about how to invest your money. Maybe you start learning about stocks. Maybe you start learning about real estate investing. Maybe you start learning about how to earn more income, because now we're going through this great resignation. People are realizing that I can do something else with my money and my time. So now maybe you get a side hustle. Maybe you earn more money. Maybe you start your own business. You start to get educated that way. Once you have a financial system, you learn how to use your money, learn how to invest your money. Now you're just adding fuel to the fire. You're earning more money, that way you can put more money into your system. This is what being financially educated is all about, because now you know how to use your money the right way. You know how to use your money like wealthy people, but now you also got to be prepared. Do you know who hates market crashes? It's the average person. Because when you see a market crash, well, then your 401k gets cut in half, and then the value of your home gets sliced in half. But do you know who loves market crashes? Rich people and wealthy people, because for them, market crashes is Black Friday, because now you can go out and buy investments at a discounted price. You can go out and start investing your money in stocks. You can go out and buy real estate. You can go out and buy cryptocurrency, and you can buy them at a discounted price. And then you just wait. You buy a good asset, you buy a good investment, and then you let the market go back up, and now you become wealthier. That's why market crashes and recessions make more millionaires than any other time, because rich people and wealthy people understand that booms and busts are a part of the cycle. So they understand this and they're prepared for it, that when something bad happens, they can come in and capitalize on it. For the average person, they're hoping and praying that something bad doesn't happen, and they're hoping and praying that their money will be okay. But the reality is things will go down. When? We don't know. But rich and wealthy people, and even if they're not rich and wealthy right now, rich and wealthy minded people are prepared for it, that when things go down, they can come in and take advantage of it. Just understanding the system, that way you can capitalize on it when the inevitable happens. Stop praying for things not to happen and be prepared for when it does happen. And that also means preparing your finances for when things do go wrong. Like when this pandemic hit, we saw half of American households hit crisis, actual financial crisis mode, because they weren't prepared. They didn't have savings, or they weren't prepared for losing a breadwinner. Unfortunately, we saw a lot of people die in 2020 and 2021 unexpectedly. I mean, it's very sad that that happened. But then also on top of that, you had all the families that were not financially prepared. So many people were not ready for the crisis that we were going to see in 2020 and 2021. They were not ready financially to prepare for that. And now so many households lost a breadwinner. And then you saw the GoFundMe funerals, where families had to go out and start a GoFundMe page because they didn't have money to fund their funeral, or they didn't have money to pay for their expenses. They didn't have money to pay for their kids. They didn't have money to pay for their lives, because they didn't expect that. And they didn't prepare for something like that to happen. One of the things that rich people and wealthy people always want to do is they want to be prepared for anything. And it's not a matter of, oh, they're rich, they can afford to do that. No, it's a matter of being rich and being wealthy in your mind before it actually happens. You have to start preparing yourself and be financially educated. That way you can be prepared for anything. One of the biggest and probably most painful financial lessons that we learned through this pandemic is, if you are not wealthy yet, if your family cannot survive just off of your assets, you need some sort of protection for your family in case a tragedy happens, using something like life insurance, because then life insurance is there to protect you, that if you were to die unexpectedly, well, then the insurance company will come in and give your family a big check. That way at least they can be okay financially. Now, I don't like the idea of investing in life insurance or trying to build wealth through life insurance. I like the idea of using life insurance as a tool, kind of as a bridge, that as you're building wealth, you have that cushion, the life insurance cushion that can protect you in case a tragedy happens. And then once you hit that wealth, once you got the assets, once you know that you and your family can rely on your assets without you having physically to go to work to put food on the table, well, now you don't need life insurance anymore because you're wealthy. But you need to have that life insurance kind of as a bridge to protect you as you're building wealth. That way you have that protection as you're working to build those assets. Second thing is you always want to make sure that you have some savings. Now, I know your savings in the bank are being diluted because of inflation, but you want to make sure you have some cash savings to fall back on in case a pandemic happens, in case you lose your job, in case you break your arm, because you never know what's going to happen. So you want to have some cash to fall back on, and this is cash you keep in the bank that's easy to access, that's liquid, because now if something were to happen, now you can easily access this money and you don't got to worry about going into debt to pay for your arm repair. My arm! And then the third thing that you want to do when it comes to being prepared is you want to make sure that you're living a wealthy life. One of the things that people realized during this pandemic is they didn't like their jobs. That's why we're going through this great resignation where so many Americans are voluntarily quitting their jobs because they're just sick and tired of the way they were treated. They didn't like their lifestyle. They weren't doing something that they enjoyed. But now people are realizing that there's more to your job than just your paycheck. You want to live a happy and a wealthy life. And like I said before, wealth starts in your mindset before it does in your bank account. That's why we're called the minority mindset, because all success starts with your mindset. If you have a broke mindset, it doesn't matter what you're doing, you're going to be broke because your mindset is broke. So the first thing you got to do is you got to have that wealthy mindset. And that means you want to be striving towards a wealthy life, not just a wealthy bank account. That means you want to be physically fit. You want to make sure that you take care of your physical health, because as we saw through this pandemic, you need to be physically healthy just in case anything happens. Then you want to be mentally fit. Mental fitness has become so much more important over the last couple of years, thankfully, where people are starting to understand the real value of mental health. So take care of your mental health. It is serious. It is important. If you are depressed, if you are anxious, and it's stopping you from being able to live your life, it doesn't matter how much money you have, you got to take care of that. Go into a treatment center if you have to. Go and get a therapist. Go and talk to a psychologist. Do whatever you got to do to take care of your mental health. Then you got to think about your spiritual health. Now, this doesn't mean that you have to be religious, but spiritual health is, what is your purpose? Why are you on this planet? What are you here for? If you don't have a purpose, you're not going to have a reason to get out of bed. But if you have the purpose, well, now you're going to want to get out of bed and start crushing your days because you love what you're doing and you're fighting for something. And that's when financial fitness, being financially wealthy, has the biggest impact. But this is why you want to be striving towards a wealthy life. That way you can live a fulfilled life, not just an empty life where you have a lot of money, but nothing else to show for it. The third thing that you got to do is you got to get your money, okay? You don't got to make money. The government and the Federal Reserve Bank are doing that. They are making money, they are printing money, and they're throwing it into the economic system. But what you need to do is you gotta attract your fair share. You gotta figure out how can you get your money into your pockets? How can you get more money into your pockets? Because at the end of the day, it costs money to eat. It costs money to put a roof over your head. It costs money to take your spouse on a vacation. It costs money to put your kids through school. It costs money to get the best health care. It costs money to buy a nice home. It costs money to have a nice car. It costs money to go to Disney World. It costs money to go to the theaters. It costs money to survive. Money is what fuels the economy. Money is what fuels the world. Now you can hate it or love it, but the reality is that is what it is. So it is your duty now to go out and get your share of the money. Now for some of you, this can be one of those things that's really hard to get your mind around because you grew up thinking and being told that money is evil. You shouldn't talk about money. You shouldn't worry about money. You shouldn't think about money like that. That's how I was raised to think. But at the same time, my parents were working their butt off every single day. My dad didn't get weekends off. He didn't get a Saturday and a Sunday off. He was working. He was working long hours every single day. And then he would tell me, don't worry about money. It's not something you should worry about. It just didn't make sense to me. But if you understand money, if you're prepared and you know how to get your money, well, then you can live a much better life for you. You can provide a better life for your family. You can provide a better life for your spouse. You can provide a better life for your kids. You can provide a better life for your community, and you can take care of people. And guess what? When you have money, people want to listen to what you have to say. So either you can continue living in this fairy tale life and tell yourself money doesn't matter and not care about it, or you can understand how the system works and get your money. Because it is your moral duty to produce something, to create value, that way now you can attract money and take care of yourself, take care of your family, and take care of your community. I'm not saying go out and do unethical things, go out and rob people, do all that. No, produce value. Maybe that means be a better worker, be a better at your job, be a better whatever it is. Get another certificate. If you want to go down that route, be the best at what you want to do. If you don't want to work a job, well then go out and learn how to produce a product. Learn how to create more value in the economic system. Learn how to get your money. You need to understand how to attract and earn money. You don't need to create money. What you need to do is you need to learn how to earn money. What can you produce to get somebody else to open up their wallets and give you some money in exchange for something else? What do you have? What value do you have that you can offer the world that somebody else is going to want to pay you for that value? And if you can become good at that, well, then you can charge more. If you become great at that, well, then you can charge even more. And if you can become the best at that, well, then you can charge even more. But you have to be good. And this takes effort, this takes practice, this takes skill, but you have to do that if you want to be able to get your money. We live in this world where a lot of people assume that rich people got rich just because of luck. Rich people became wealthy just because it fell into their laps. But you ignore all the hustle, the hardship, the learning, and everything else that goes into it in order to get there. You can do it too. It doesn't matter where you start, doesn't matter what you look like, doesn't matter where you come from. YouTube has decentralized education. That's why I love YouTube, because now you can learn anything you want from whoever you want. You can learn from people that are actually doing it, and it's going to cost you nothing. It costs you $0 to go out and learn how to invest. It costs you $0 to go out and learn how to start a business. It costs you $0 to go out and learn how to get another job. It costs you $0 to learn any of this. And if you don't like your teacher on YouTube, just go find another teacher. That is why YouTube is changing the game, especially when it comes to education. But now you have to go out and start learning, and then you got to do something. But it is in your hands. Doesn't matter where you come from. First you got to learn, then you got to have the right mindset, and then you got to do. It's not easy, but it's not impossible either. If you want it, you can get it, but it is your duty to get your money. That way you can take care of yourself, you can take care of your family, and you can take care of your community, because if you don't do it, nobody else will. I'm telling you straight from myself here, because these are things that I never grew up being told. These are things that I never grew up learning. I saw how hard my parents worked. My grandparents were refugees. I have seen all the hardships and struggles that my community, my religion has gone through, which is why I want to go out and do something that way people listen to me, that way people can learn from me, that way then I can spread the message about what has happened, and I can talk about the things that I want to. If you want to go out and make an impact in the world, guess what? If you have money, you can make a bigger impact. In 2020, we had a very weird economy. At first, when the pandemic hit, everybody got scared because businesses were being forced to shut down, people were losing their jobs, people stopped making money. But that's when the government came out with their own unemployment program, and then people started making more money. And then people started going back to work, and then the government started sending out stimulus checks. So now you had a lot of people that didn't lose an income, but they lost a lot of expenses because you weren't allowed to go out and shop because malls were closed and people didn't want to go outside of their home. So people were sitting in their homes, they were stacking cash, and then the government created new forbearance programs which said that you don't have to pay your mortgages, you don't have to pay your student loans, and a lot of people were not paying the rent. So all of a sudden, you were making the same money as before, and a lot of people were actually making more money during the pandemic thanks to the help of unemployment programs or thanks to the help of stimulus checks on top of regular income. So people were making more money with less expenses. So now all of a sudden, people had extra cash and they didn't have anywhere to spend it. So people started saving, they started investing, and they started paying down debt. CNBC Make It reported that a third of Americans say that they got better with their money during the pandemic. Fortune said that Americans invested more money in the past 5 months than they did in the last 12 years. And then CNBC also said that Americans paid off a record $83 billion in credit card debt in 2020. It was a really strange phenomenon we were seeing because on one hand, we were arguably in one of the worst recessions in decades, and on the second hand, people were getting smarter financially and people's finances were actually improving because they were still making money and they didn't have the expenses that they had. I'm a money nerd, so when I read that Americans are paying down their credit card debt and now they're investing more and they're building up some cash savings, this made me very happy and I got very excited about our future. But it looks like Americans are making a U-turn with their finances because you have millions of people going back to the same bad spending habits that they had before, and now they're accelerating them. Wallet Hub just released this brand new credit credit card study. And let me just read you this first paragraph. It says that US consumers have started to return to bad habits when it comes to credit card debt following a record-setting reduction in 2020 that continued into the first quarter of 2021. During the second quarter of 2021, consumers added $45.7 billion to their credit card tab. That is an all-time record that nearly wiped out the first quarter paydown that we just talked about. And furthermore, Wallet Hub now projects that consumers will end the year with a net addition of $100 billion in credit card debt, which far exceeds the 10-year average of $45 billion. This is absurd. So many people had the opportunity of a lifetime to finally start building wealth because you had the opportunity to not spend money while you were still making money. So people were stacking cash, they were paying down this expensive debt, and people finally, for the first time ever, had the opportunity to start building wealth. You had a head start in everything because the government shut down your expenses. And now people are going right back to their bad spending habits that put them in the financial mess that they were in the first place. Just look at this credit card debt chart between 2019 and 2020. In 2019, we had about $75 billion worth of credit card debt. Then you see this massive crash. It looks like the stock market crash, but it's actually credit card debt crashing. In 2020, we saw a record low amount of credit card debt, and then in 2021, we broke all records again. You can just see the credit card debt skyrocket. And then if you scroll a little bit lower, it shows you that the increase in credit card debt during the second quarter of 2021 was almost 3 times bigger than the post-Great Recession average for the second quarter. When I read this article and I see the charts and I see what's going on with people's finances, the only thing that I want to know is why. Why would you throw away this golden opportunity? Why would you throw this away when you had the opportunity to build wealth literally delivered to you on a silver platter? Why would you throw away the opportunity to take care of your family when you had it given to you? But it goes to show the power of everything we talk about. Building wealth and becoming financially successful has nothing to do with how much money you're making. It has nothing to do with who your parents are. It has nothing to do with what degree you have. And it has everything to do with how you use your money. Financial education is the backbone to anyone's financial success. It doesn't matter if you're making $100,000 a year or $1 million a year. If you do not know how to use the money that you're making, you will always be broke because you do not have the financial education that you need. And so many people, so many Americans do not have that financial education, or they want to stay ignorant to this type of financial education, so they will continue to stay broke even when you have the opportunity of a lifetime just delivered to you on a silver platter. The funny thing is, if you took a survey of people who are struggling with money, every single one of them will say that if they just made more money, their financial problems would be solved. But the issue with that is more money can only solve your financial problems when you are financially educated. If you're not financially educated, more money will just make your financial problems worse. More money fixes financial problems with financial education, but more money cannot fix stupid. Look, if you want to fix your financial problems, you got to cure the stupid first. Because if you have more money is just going to amplify the stupid. So you got to take care of the stupid, and once you do that, now the more money can amplify your financial education. In the middle of a pandemic and a once-in-a-lifetime recession, do you know who came out as a big winner? Luxury brands like Louis Vuitton and Gucci. LVMH, the owner of companies like Louis Vuitton, made record sales in the middle of a pandemic, and they made more sales in the pandemic in a recession than they did prior to the recession and pandemic. LVMH is a luxury brand conglomerate, and they own brands like Louis Vuitton, Christian Dior, and Tiffany, and they are making billions of dollars more now than they did before the pandemic because people got that extra cash and they want to spend it on looking rich instead of actually wanting to be rich. Now, don't get me wrong. I don't got anything against luxury. I love luxury. There's nothing wrong with having a $3,000 purse. There's nothing wrong with driving a brand name car. There's nothing wrong with owning $10,000 worth of jackets. The only problem is if you're buying this stuff before you can afford it, well, now you're making somebody else rich at the expense of your richness. I don't have an issue with people blowing money. I mean, it's actually a good thing. You're buying something that you like and you're supporting the economy, you're stimulating the economy, you're spending money. So there's nothing wrong with spending money and having a whole bunch of nice things. The issue that I have is when people are blowing their money to buy these nice things before they can afford it. See, I have no problem if you're buying nice things and you can afford these nice things, keyword afford, not just buy, because there's a difference between being able to buy something and being able to afford something. But the issue that I have is you have so many people buying these expensive, nice things before they can actually afford it. I was talking to a handyman slash contractor that I know the other day, and he was telling me why he didn't want to buy this bigger home. He said that he really liked the home, but the issue was if he bought the home, he would have a very expensive utility bill. He'd have to pay for more electricity, he'd have to pay for more gas, and he didn't want to have to do that. But the issue is, if you're buying a home and your concern with buying this home is how much your utility bills are going to cost you, your priorities are in the wrong place. You probably can't afford that home if you're worried about what the utility bills are. You need to figure out what you can really afford if you're worried about paying the gas bill. Anytime someone starts talking about their financial stresses and why they're struggling financially, you start to see the blame game. People start to point fingers. It's the government's fault. They're not taxing the rich, or the government is taxing me too much, or it's my corporation's fault, or it's my boss's fault, or it's somebody else's fault. We just keep pointing fingers, pointing fingers, pointing fingers. But what you got to understand is when you're pointing your finger at somebody else, you got three fingers pointing back at you. There are issues in our economy. We are seeing rising inflation. We are seeing the rising cost of living. We are seeing things become less affordable. You want to go to the grocery store? It's going to cost you more money. You want to go on a vacation? It's going to cost you more money. You want to go out and buy a home or rent a home? It's going to cost you more money. This is the reality of the economy that we're living in. And yeah, this is somebody else's fault. This is because of all the money printing. This is because of bad regulations. But at the same time, you are also the person spending money on things that you don't need. If you have or if you finance your newest iPhone and you're driving around in a finance Beamer and you're wearing these designer clothes, and then you go around saying that the reason why you're struggling financially is because your grocery bill is $50 more, something is wrong with the way that you're running your finances. The saying is, when there's a will, there's a way. If you really want the brand new pair of Jordans, you will find a way to go out and buy it. You will do whatever it takes, cut back your costs, you will earn more money, that way you have the cash to go out and buy these Jordans. If you really want to wear a Gucci wallet, or if you really want a Louis Vuitton purse, you will find a way to get the cash to go out and get it. You will do whatever it takes. You will make the sacrifices. You'll find a way to earn some more money. That way you can get the money to go buy this luxury item. And if you want to start building wealth and you really want it, you will find a way to cut back your costs and earn more money so you have more money to build your wealth. America is known as the land of the free and the home of the opportunity. That's why so many people are willing to literally risk their lives to come to this country. And the reason why it's known as the land of the free and home of the opportunity, because you are free to spend your money as you please, and as the home of opportunity because you have the opportunity to build wealth if you so please. It's not easy. That's why the majority of people will never do it, but the opportunity is there for the minority of people who want to seize this opportunity. My grandparents were refugees. When my home state of Punjab was severed by the Indian government in 1947, my grandparents lost everything. They lost their home, they lost family members, they lost their money, and they had to literally pick up and run for their lives with a sword in their hand. My grandfather saw his uncle get killed right in front of him because someone slashed him with a sword on the head, and so he had to continue running. By the time he got to the new side of India, he didn't even have shoes on, and he had to find a way to make it work. My parents grew up in India, where you don't have the same opportunities that you do in the United States, and in the 80s, when our home state of Punjab was bombed by the government, that's when my dad said he wanted to leave. So then my dad left India, came to the United States with less than $100 in his pocket, didn't know the culture, didn't know the people, but found a way to make it work. I didn't grow up learning about financial education or investing or money, but the reality is, if you are born in a first world country and you have the ability and the means to understand and watch this video, you have everything that you need if you want to become successful. Now it's up to you. What are you going to do with all the resources that you have around you? Are you going to blow it? That way you can look rich while you're actually making everybody else rich and then just complain about how the system keeps screwing you over? Or are you going to learn how money works? That way you can take care of yourself, that way you can take care of your family, and that way you can take care of your community. The freedom and the opportunity is there. The decision has to be made by you. And I'm curious, what is this extra $5 for? So I called up the gym, and they said that they signed me up for a magazine that I never knew that I signed up for, and that's why they were charging me an extra $5 a month. Now, I've had my gym membership for years, and I'll probably continue to have my gym membership for many years into the future, and they were just slapping on this $5 fee because they probably thought no one's going to check their bills.